Many of you have asked about Lendlease Global Commercial Reit. I'll touch on it in a quick while, but today I have a story for two of these fantastic REITs. The first is in the office REIT space. This REIT has gained 15% year to date already, but they are not the best performer. The best performer comes from hospitality segment, not my Ascott Trust. This hospitality REIT has gained 23%. So today I have all the findings that you want, and we'll touch on some key REITs that also exist in the Singapore space that you should take note of. With that, let's roll in the intro video. Hi guys, welcome back. Let's start with Lendlease Global Commercial Reit, and I promised you some important insights and information. You know, Lendlease Global Commercial, they have previously owned 313 Somerset only. It's a fantastic mall, and I go there quite often. You might even see me there because my son has a class that's nearby on a Saturday. But they've recently purchased GEM. Now, if you are a Westie living in Clementi, Jurong, I'm sure you love GEM. And GEM is actually a great mall. They have about 99% plus in terms of occupancy. So the mall is definitely fantastic. But why is Lendlease Global Commercial Reit not at the top of my list today? Let me show you this recent transaction first. You know, they've acquired GEM, and this acquisition price is pretty expensive. $2.079 billion. And the estimated fair value from two property consultants, Jones Lang as well as CBRE, were between the 2.086 and 2.063 billion range. So it's fair value. Not that GEM is in distress, you can buy it cheap. But also, at this purchasing price, the net property income yield is only about 3.9%. So my guess as to why Lendlease Global Commercial Reit hasn't seen a jump in terms of share price could be this purchase price isn't spectacular. And after this purchase price, they have increased their gearing by quite a bit. As forecasted by Philips Securities, their gearing ratio will spike up from 30+% all the way to 40+%. And this acquisition will be 58% of its portfolio in future, which means its fate is going to be tied a lot to GEM. Not that GEM is a bad mall, it's just that this is a big acquisition, and because it's a big acquisition, they had to raise money. This is the second point that I'd like to highlight also a bit. If you see this acquisition, they can't stomach it with its existing cash, so they had to come to the markets to raise money. They firstly sold a perpetual bond, but the most important part is that they have raised equity. And their raising equity price is 72.5 cents. This is slightly below its trading price of about 79 cents at the point of market release of this news. Not that REITs have never sold new shares at a lower price. In fact, most of them actually do so. CICT recently sold some shares at $1.96 only. But my biggest take is that this 72.5 cents new shares is actually way cheaper than its IPO share price. Lendlease, they IPO'd in October 2019 at 88 cents. So at that point of time, they only had 313 Somerset as well as some Italy properties. To bring in this acquisition, now they're selling it at 72.5 cents. And I think Mr. Market is not too pleased about it because of the discount to the book value that new shares are being offered at. Well, I do understand that there are certain pros. Lendlease Global Commercial REIT becomes a bigger REIT, becomes more visible, can attract new shareholders. And the second part is that it has more tax transparency because previously it invested into GEM via funds. And when it's via funds, there is a tax that they need to pay on any dividends they receive. So while there are benefits, the cons is quite obvious that this does not benefit existing shareholders that much. Let me know in the comment sections whether you agree or not. And as always, smash the like button early. We'll cover the two outstanding REITs in a quick while. Now in this section, let's touch on the top performing office REIT, and that is, drumrolls, Suntec Reit. If you plot it against Mapletree Commercial Trust, which is right now in an acquisition phase, so not too fair, sentiment different from the rest. If you plot it against also CICT, Keppel Reit and Lendlease Global Commercial Trust, you realize that Suntec Reit has done the best year to date, clocking in 15.69%. Previously I've highlighted Suntec Reit has that problem of convention center, which will cost it $4+ million in terms of loss. But conversely, right now, that problem is now a plus, simply because as we open up from this whole COVID-19 lockdown, we're going to see more conventions. And that's why myself, I went down to Convention Center just to check it out. And today I'll be playing badminton with Jared Ong. He is also on YouTube, you can check it out. And Jared is actually an ex-national player. So if you are keen to find out on our badminton clips, do let us know. Maybe we can film something and share it with you, especially if you are also a keen fan of badminton. Now let's go back to Suntec Reit. The key part about Suntec Reit is a few points. Convention Center is not a big money maker. If you see in terms of history, they clocked 13 to 18 million in terms of profits, even in its heydays. The key part about Convention Center, let's get it correct, is that it can bring in more traffic that will also help its mall do well. You know, the mall has been suffering for quite a bit because people work from home, they don't come to Suntec City. But myself, I like to go to Suntec City because it's relatively quieter. But I do see increasing traffic already. And with conventions coming back, like baby fair, car fair, bridal fair, I do suspect that the mall's occupancy rate will start to climb up, which means also they can start to charge more in terms of rent. From a previous video, I've also highlighted that Suntec has invested over the last few years into Australia and into UK. So it's reducing its dependency on Suntec offices. Its Australian property in particular has seen a revaluation gain, which means they have entered at a good period. Right now, the value of property has appreciated. And they are slightly ahead of other players such as CICT, which is now moving only into Australia. But with that, I also like to highlight another REIT, which is Keppel Reit, something I haven't covered on this channel. Do you know that Keppel Reit also has quite a bit in Australia? They have 35.57% allocated in Australian offices. I'm not such a big fan of Keppel Reit because Ocean Financial Centre is a big piece of what it owns and they are fully office. But if Australian officers start to do well, they should also see some benefits in some ways. But as I mentioned just now, Suntec Reit's 15% has been bested by this other smaller known REIT, which is Frasers Hospitality Trust. Now, if you have followed this channel, you do know that I'm big on travel. That's why I've been mentioning Ascott Trust, other hospitality REITs quite a bit, including CDL. But I haven't covered before Frasers Hospitality Trust. And if you look at the charts, you realize that they have outperformed everybody in the space, including Far East Hospitality and OUE Commercial REIT, which I'll cover in a quick while. Their outperformance is huge, delivering 23.4% year to date. Now that is crazy and it got me digging into their books. But I really couldn't find anything spectacular, I'm sorry. They have recently expanded to Cambodia, not such a big difference. They have, as of today, mentioned no proposals or strategic changes. So I really don't know what are they doing. Is there something going on that we are still not aware of? The only plus side is that, Singapore travel has increased by 18.5%, but that should benefit everybody in the sector and not deliver such a big outperformance versus the rest. Frasers Hospitality Trust actually has more in Australia than in Singapore. So it's really not a pure Singapore hospitality play in any case. For a bigger exposure to Singapore hotels, I'd much rather CDL Hospitality Trust, which owns W Hotel. They have more than 40% allocated into Singapore. But having spoken to here, I would also like to bring up a discussion on OUE Commercial REIT. This has been mentioned in the comment section, so I do actually read. As usual, do leave your comments below. OUE does have some hospitality assets, 27.1% to be exact. And that is actually attributed to its Mandarin Orchard Hotel as well as Crowne Plaza in Changi Airport. Of course, it's arguable whether OUE should be a hospitality REIT or office REIT because offices do take up 59% of the portfolio. But I'll share with you my thoughts on OUE. If we pull up the chart over here, you'll see that it's underperformed significantly, correct? The sponsor isn't as strong and well known as the rest. And my style of investing is usually when it underperforms, I tend to avoid it. Maybe Mr. Market knows something about the quality of earnings moving forward that we are not aware of, more than it being a bargain cheap price. So that's my take on things, just in case you are a OUE commercial fan. But I'd like to end this discussion on Ascott Trust, which is something I've covered before, and I'll give a quick update, just in case you're also keen on the hospitality segment. Ascott actually owns service apartments, as you know, but they own it globally, some in Singapore, some in US, some in Australia, and recently they have been buying a lot of student accommodation. This new acquisition is in Japan, $125 million. But in terms of the overall weight, in their portfolio because they own 7 billion of properties. This is still fairly small and doesn't move the needle too much. It brings their gearing up to 38.3% after this acquisition, but Ascott Trust seems to be a good manager and they have been acquiring properties and growing their portfolio well. These 4 rental housing properties have an average stay of 2 years and a master lease for the studio accommodation of 15 years. So Ascott Trust is really trying to diversify and reduce its cyclicality in terms of its earnings, which means, the travel sector is ups and downs, but they want to build in a lot of stable assets. And in my opinion, as an investor, I'm quite happy to see it also. So as always, if this tutorial has benefited you, smash the like button. Let's recap the top 2 names, which is Suntec Reit, I'm favorable on it now, and secondly, which is on Frasers Hospitality Trust. This, I'm not too sure about the search. I probably would avoid it. Maybe that has given you a hint on what I like and what I don't. And as always, smash the like button if you benefited, and I'll see you in the next video. Invest safe, take care, and goodbye.